Every day in London, billions of ounces of silver are traded on paper. Futures, forwards, swaps, lines of code, and promises of delivery that create the illusion of endless supply. But if you strip away the paper and walk down into the vaults, the truth looks very different. Those vaults, once overflowing with bars stacked high like a fortress of metal, are being drained year after year. The entire system relies on one fragile assumption: that almost nobody will ever ask for their silver in physical form. That faith is what keeps the market alive. But history shows us that when the weight of promises grows far larger than the ounces in existence, something eventually snaps. And now, in the autumn of 2025, the signs are growing louder that silver, and gold with it, are about to expose the weakness at the heart of the Western financial system. The headlines already tell a story most investors thought they'd never see. Gold has broken above $3,800 an ounce in US dollars, a record high that shatters decades of conventional wisdom. Silver, too, has surged more than 60% this year, pushing beyond $44 an ounce to levels last seen in 2011. For years, analysts argued that silver was doomed to lag gold forever, a forgotten cousin in the precious metals family. But now the gold-to-silver ratio is narrowing, a historic signal that silver's move is real, not hype. This isn't just another rally. It is the market shouting that confidence in the dollar, in treasury debt, and in the financial architecture of the West is eroding. Why is this happening now? Because the U.S. is running headfirst into the limits of its own system. The government has piled up more than $37 trillion in debt. Treasury auctions are growing heavier each month as Washington borrows hundreds of billions just to stay afloat. Foreign buyers, once dependable, are quietly stepping back. The Federal Reserve, already boxed in by inflation and slowing growth, is signaling rate cuts to prevent recession, even as inflation proves stubborn. That combination, soaring debt, weakening dollar, and a central bank trapped, creates the perfect storm for gold. And silver, being both a monetary and industrial metal, is riding that wave with even more explosive force. Meanwhile, London, the world's largest hub for silver, is seeing inventories collapse. According to LBMA data, vaults that held nearly 1.1 billion ounces in 2021 now contain fewer than 800 million ounces. That is a 30% decline in less than 5 years. At first glance, 800 million ounces may sound huge, but most of that silver is not actually available. Much of it belongs to ETFs, to long-term holders, or to institutions that have no intention of selling. Analysts estimate that the true float, the silver that can actually be mobilized at short notice, may be closer to 155 million ounces. At today's consumption rates, that represents barely 6 weeks of demand. If the current pace continues, London's deliverable silver could effectively vanish within months. Western investors should pay close attention to what the plumbing of the market is revealing. Silver lease rates in London have spiked above 5% this year, levels rarely seen in modern times. This is not just a number, it is a red flag. It means those who need silver are willing to pay steep premiums to borrow it because supply is tight. At the same time, COMEX futures in New York are trading at premiums of up to 70 cents over London spot prices, highlighting physical scarcity and arbitrage stress. European refiners, facing tariff threats and the reclassification of silver as a critical mineral, have shifted capacity toward gold, leaving less silver available for recasting. ETFs in the US and Europe have absorbed more physical metal, locking it away and removing it from circulation. The message is clear: the float is shrinking, while both industrial users and investors are demanding more. And this is not a passing squeeze. Silver is running structural deficits. Over the past 5 years, the world consumed 800 million ounces more than it produced. In 2025 alone, the deficit is projected near 190 million ounces. These aren't hypothetical projections. They are missing metal, real ounces that left the system and were never replaced. Why? Because industrial demand is rewriting the rules of the market. Silver is no longer just a safe haven asset. It is a vital input in the global economy. Photovoltaic cells and solar panels, the backbone of renewable energy, require vast amounts of silver. Electric vehicles use it in wiring, batteries, and sensors. Advanced electronics need it for conductivity. Unlike jewelry, which can be cut back in hard times, these uses cannot simply stop. Governments across the West are mandating green energy transitions, EV adoption, and digital expansion, and every one of those policies quietly translates into more silver demand. The problem is, supply isn't growing fast enough to keep pace. Mining output is constrained. Recycling cannot fill the gap, which means inventories, already falling, must cover the shortfall. And so the market signals what it feels. London silver has been in backwardation out to 12 months, meaning the spot price is higher than forward contracts. In commodity markets, that is a siren of shortage, proof that today's ounces are more valuable than tomorrow's promises. Lease rates remain elevated across maturities. Arbitrage gaps between exchanges persist. COMEX still delivers millions of ounces. September alone saw 60 million delivered, but deliveries are not the same as security. The system is still functioning, but the cracks are undeniable. Here is the truth investors in the West need to hear. The vaults are not yet empty, but they may as well be. What matters is not the headline figure of ounces in storage, but the amount of silver that can actually be delivered when demand spikes. And that pool is shrinking every month. For a large industrial user or a government reserve buyer, sourcing significant silver is already difficult. For the individual investor, waiting until the crisis becomes obvious means being shut out. By the time the mainstream admits there is a shortage, prices will already reflect it. This is not just theory. We've seen it before. Palladium in the 2010s quietly slipped into deficit. Inventories dwindled year by year until suddenly the market woke up. From that point, the price didn't rise gradually. It exploded sixfold in 6 years. Oil has done the same when supply shocks collided with demand that couldn't disappear. And gold itself, in the 1970s, erupted when confidence in the dollar evaporated. These aren't abstract parallels. They are the exact pattern now emerging in silver. The West, and especially the United States, is at the center of this. The dollar is weakening. Treasury auctions are faltering. The Federal Reserve is boxed in. Gold's surge past $3,800 is a global vote of no confidence in the system that underpins American financial dominance. Silver's rally is a sharper, more urgent echo of that same signal, and Western investors must recognize what that means. Paper promises, futures contracts, unallocated holdings, leveraged ETFs depend on a system already stretched thin. When the cracks widen, only physical, allocated, and verifiable holdings will matter. So here is the direct message to every gold and silver investor in the West. Do not wait for the vaults to be officially empty. Do not expect headlines to give you time to react. Gold's breakout tells you trust in the dollar is already fading. Silver's surge tells you the industrial economy and the financial system are colliding in real time. These metals are not just trades. They are lifelines. Gold preserves purchasing power in a world where debt is unpayable. Silver provides asymmetric upside in a market structurally short of supply. If you delay until recognition is mainstream, you will already be too late. The story of gold and silver in 2025 is not about hype or rumor. It is about numbers. Inventories down nearly 30% in 5 years, a half-decade of supply deficits. Borrowing costs at multi-decade highs. ETFs swallowing more ounces by the week. A global electrification push just beginning. Gold at all-time highs in dollars. Silver breaking decade-long barriers. These are the facts. The conclusion is simple. The Western financial system is more fragile, more leveraged, and more vulnerable than at any point in recent memory. And the metals are warning you in plain sight. As this chapter of history unfolds, remember that silver and gold are not just commodities. They are signals. They are mirrors reflecting the state of faith in money, in credit, and in power. Gold breaking higher says trust in the dollar is fading. Silver accelerating faster says the industrial economy itself is at risk. Together they form a single message to Western investors. Prepare now while you still can. Because when recognition comes, it won't be gradual. It will be sudden, violent, and irreversible.